Hello everyone, welcome back to Case Studies with the BizDoc. This week it's Spotify, and we're digging into a more traditional case study and taking a look at a company that has been growing and doing well by certain measures, but now they have to go out in public as a big grown-up company and be profitable as the industry that they're in is changing rapidly. So think about industry change, think about reacting to your environment, and then thinking about market share and being in a control position. All of that is all wrapped up into the Spotify case study as they think about their IPO, and we go take a look inside the company and at their history and see what we think about it. Well, first of all, we go to the history of music. Once upon a time, we bought albums. Then we just bought songs. 45s we bought, and then we bought only individual songs as we downloaded them on iTunes. And the record industry was terribly upset that we could break the $17 price we were paying for an album, then a CD, and break it into only pay 99 cents for the one song, or 99 cents each for the 2 or 3 songs that were on the CD that we wanted. That now we're just point to the ones we want on Apple iTunes, and we downloaded them. And then the controversy of free music and Napster was in there, but nonetheless, the album was broken into little parts and we were buying songs. Then, now, today, we've gotten into streaming. Like, select one of those old songs you like and make a radio station around it on Pandora and pay $9.99 a month to listen to songs that are similar to that songs. So now we're listening to themes based on favorite songs, or we just listen to genres on, Apple. We go to Apple Music, we say, hey, show me Pop 2000, all the things that were popular as the century flipped. And that's where it got to. And in the middle of this, emerging players came up, and one that was in streaming and songs and themes, and all of this was Spotify, who, spoiler alert, right now is the #1 streaming service in the US with about 45% of the streaming subscribers. How did they get there? Well, let's look at the history. It all started in 2008, way off in Europe, Northern Europe. Daniel Ek gets together with a friend and creates Spotify. $21 million Series A. These are the venture capital runs that I'm going through right now. Then a $50 million Series B in 2009, $20 million Series C 2010, a $100 million Series D at the point they announced we have 1 million paying subscribers 6 years ago in 2011. Then backing it up with another $100 million, this time a Series E in 2012. Then 2013, a $250 million Series F. And then going out the 13, did I say 15? But 2013, then 2015, $526 million Series G for a grand total of $1.1 billion in venture capital invested by all these investors who have got no return yet. They're letting it ride. It's like the money's on the blackjack table, and they're hoping the dice come up 7. They are in for the long haul, looking for an acquisition or looking for an IPO, looking for an exit, but more importantly, looking for Spotify to show itself to be a grown-up company generating profits. So now we go take a look. Along the way, there was bumps in the roads. It was slow getting started. If you look back here, this is only about 3-4 years after the app started, and then unlimited data plans and everything enabled you to get more out of music streaming services. Then we all remember 2014. This is Taylor Swift, and she looks upset. That may not look like Taylor Swift, but it was Taylor Swift, and what she was saying is, damn! You're not going to put my music up there for free. Pulls all of her stuff off Spotify as the recording artists were saying, damn it, I've created all this music and now it's out on streaming services. I wish the performing rights organizations that are supposed to be protecting my copyright, I wish the record labels and other people be protecting me, and I'm not putting my music out there for free. If I can't sell a CD, I certainly want to be able to sell songs, but if I can't sell, I don't want this stuff just out there so I can get pennies on the dollars on a streaming. So in the background, the recording industry was fighting amongst itself and trying to figure out how they were going to hold the streaming services to some sort of royalty rates. Meanwhile, streaming services were popping up, and the recording industry wanted consumers like you and me to be listening to music, but they also wanted to be making a buck off of it. So along we go. Here, The last money raised in 15, well, that was 20 million paid subscribers. Then in 16, the early part of 16, they said, we've crossed 30 million paid subscribers. Then halfway through 16, we've crossed 40 million paid subscribers. And finally, here in 2017, 50 million subscribers, and we are 40% of the streaming subscribers in the US. We are #1. But we need more money. And so they go out, and the venture guys are done. They're saying, you're going to have to raise money differently this time. Well, they go out and get 1.5 billion in debt and a note. Well, the debt and the note came with some terms. And the first was, hey, I'm going to put this in, but you have to go public within a year. In other words, you have to go on IPO on the stock market, because when the company goes on the stock market, the first transaction, when you and me and millions of other investors can buy stock, that is, we buy the shares that are owned by the venture capitalist or the note holder. That's how they get their return the first day on the stock market. The first public offering, their money gets converted from our money, and then we trade amongst each other, and every day we look up there and we hope that the stock price is going up and going higher. Well, what they said was, hey, we get a 20% discount when the shares go public. In other words, if the share was going out there, say, for $10, then they get to buy it for $8 in exchange for giving, $1.5 billion to them. So Spotify finds itself with a gun to its head. You either go public by a certain date or this just gets worse. That was the only choice they had. Now then, what's going on in music streaming? Wouldn't you think that if you're #1 and you're 40% of the music streaming, that you would be making a profit? And so hang on. So to raise 1.5 billion in money, when the venture guy said, well, we're done here, they had to give up a discount on stock, and they had an ever-increasing interest rate with the gun to their head. Yep, let me tell you, that's expensive money, and there is only one word for that, and that is damn! What are you thinking? Unless you had no choice. The #1 thing for the music streaming people is licensing cost. How much do you have to pay the record labels and the artist? That is everything. Yes, there's hosting costs and there's transport costs and some marketing costs and other things in there, but the big lion in the room with no cage around it is the licensing cost. And if you have to operate at such a small margin, you're not going to be able to operate a company and pay them what they want for licensing. Well, recently, Universal Music Group, the biggest, and Merlin, a group of independents, did new deals with Spotify. Spotify hopes those deals are going to lead to getting deals with the rest of the music industry, and that as the 40% player, it can use that weight and that status to get deals with people that the record labels like, that the recording industry likes, that the artist likes. Actually, I should say it, that the artist likes, the record labels like, and therefore the recording industry as a whole likes. That has to come together so they have a viable business. Because right now, 2014, the revenue was 1.14 billion. They didn't say what their loss was, but it was a loss. And many people speculate that this was over $100 million loss. In 2015, it was $2.1 billion in revenue and a $244 million loss. And in 2016, they had announced that it was 3.1 in revenue and a $568 million loss. And a big chunk of this was interest they had to pay on the bad note. So the estimate is that they really lost about 310. Well, that means your loss is growing even as your sales are going. And you know what? Wait a minute. Let me go into the other room and show you what's going on in the recording industry to see that Spotify should actually be in a strong position. Let's go take a look. Okay. I'm back. First, before we go any further with Spotify, we got to talk about what's happening in streaming. It's really big, and this will help you understand the case study and also understand that the sea change that's going on in music is everything. It's forever being changed. Let's step in. Right now, in the streaming world, you've got Spotify with about 40% of the streaming subscribers, and then you got Apple Music Not iTunes download, but the Apple Music at about 20%, and then, Amazon. Is there anything that they don't have their fingers in? Answer, no. Amazon Music, which is Amazon Prime Music, Amazon Music Unlimited, about 12%, and then everybody else at 28%. SoundCloud, Deezer, Google Play, Pandora, anybody that's selling, remember Pandora Premium, not Pandora Free, and Sirius Satellite Radio, which is a subscription service, are in here. And the subscribers there in 2015 was about 10.8 million in here. 2016, which is this mix, it was 22.6. In June, just now, June of 2017, it's 30. This is growing like wildfire. How big? Well, let's go take a look. In 2016, let's just look at the dollars in the music industry in the United States, and this will make sense. $7.6 billion spent by you and me, one way or another, on music. 3.9 billion was streaming, or about 51%. 3.7 billion was sold. Well, wait a minute. That was the first time in history that streaming revenue was bigger than sales. Let's take a look at that. 1.4 billion was ads, like we listen to something and get ads. That's the free Pandora and other things like it. 2.5 was subscription. In other words, 33% of the music industry income last year was streaming services. In other words, you paid for a stream and you listened to it, thumbs up, thumbs down, you heard more of what you like. You were just paying a flat fee per month. You make your song mixes, do whatever you want on Pandora Premium or on Spotify or on Apple Music. And that was up, by the way, really up. Physical sales, albums, CDs, and stuff, believe it or not, that's 1.8, and vinyl is making a big comeback. But needless to say, it's a quarter of the music industry still, and just kind of holding flat. Meanwhile, downloads, and most of this is iTunes, was down 1.9 billion. It was 2.3 billion the year before. So sold music is dropping through the floor with albums and CDs holding steady, but with downloads, paying for downloads, like on iTunes, which is the biggest, boom, falling through the floor, with streaming coming up. Now then, interesting thing, June 30th of this year, so just a little bit ago, June 30th, guess what? The mid-year numbers came out. Streaming is now 62% of the music revenue in the United States, which means the war is over. Streaming is just taking over everything, and digital downloads continue to crash. I don't know if it's true for you, but this is true for me. I haven't downloaded songs on Apple in months, and back then it was like 1 or 2 songs. As a matter of fact, I think the last song that I downloaded on Apple iTunes, where I actually paid for a download, $2.49, whatever it was Harry Nilsson's You're Breaking My Heart. It's a really old song, goes back to the 70s, but Harry Nilsson, You're Breaking My Heart. You should go listen to it, because that song was all about my relationship with Sirius Satellite Radio, which I talked about in a previous case study, that when they raised the price to $400 to have both my cars have Sirius Satellite Radio, I said goodbye to my Sirius Satellite subscription, and that song is how I feel about it. And so now we're going to take a look at this through the lens of Spotify to say, with all of this happening and things going on in the music industry and Spotify being 40%, yet we're going to take a look at the losses, and how do you take a company public that has those kind of losses? So let me go back to the other room, to the other board, and get back to Spotify. Okay, I'm back. Well, hopefully that helped you see that the recording industry in the United States, music in the United States, is actually in great shape. As you saw, people are streaming. They're still actually buying some physical CDs and a lot of albums. Albums are making a comeback because the sound is so pure and so nice. A lot of people want those. Me, I just want to point and shoot and get the songs I want. But you also saw that streaming is growing and killing digital downloads. So when it comes to phones, we don't want bigger phones to get those digital downloads. What we want is a streaming service at a reasonable price to go, point and shoot, and select the themes and songs, create our own radio stations, and create our own mixes that algorithms like Pandora automatically show for us. But as you can see, Spotify's #1, and there's a lot of people that are out there dying. And what's interesting, if you think back what I just showed you, Amazon, Apple, Spotify, and then also a little bit of Google Play in there. Let's take a look. Amazon, big stack of money. Apple, big stack of money, bought Beats, basically has discontinued Beats as a music service, basically, and they're offering Apple Music right now, which I subscribe to, which is pretty good. Then Google Play. So 3 of those players are big enough to say at some point in time, as all those other little ones sort of die away, which is gonna happen, I think the big one, I would not be surprised to see a player like Apple. As a matter of fact, I think this would be a perfect purchase for Apple. Apple makes money on the App Store. Apple has an ecosystem. Apple Music is now pretty much, given way to the thematic $10 a month where I can get my radio stations and things like that on Apple. So they could buy this and just add all these subscribers into Apple Music as all of the other contestants go away. The other one that I think is looming in the distance is Amazon. Amazon Music already in a big position. So basically, the case study on Spotify is, I think it has successfully got itself into position in the midst of a changing marketplace and a changing ecosystem. And it's fought and got itself to number 1. But it's got to control its internal cost and get those licensing deals with the other ones and show that it can be profitable so it can have an IPO that's successful. Otherwise, this discount rate and what they're paying, their note, is just going to keep going higher. In other words, even if Spotify, as big as they are, and as much money as they still have in the bank, and they still have hundreds of millions of dollars in the bank that they're bleeding through, there is a waterfall coming for Spotify that they're inevitably going to go over. And I could see Amazon and Apple just sitting there patiently waiting as the ecosystem sort of sorts itself out, and people like Sirius, Pandora, Spotify are left, and then they can make decisions on which one they buy. And what's old becomes new again. Suddenly the record industry that was controlled by a few kind of goes nuts, starting with Napster and all these different services, and Slacker and Deezer and all the ones that are in there. Comes back to a few players along with radio, iHeartRadio, which used to be Clear Channel Communications. There you have it. I hope they make it. I hope they're able to get licenses with everybody else and get that together and control these losses so that they are a going concern capable of an IPO that erases and pays off these bad deals on the last money that they got in the bank so they could survive. Because I think we all need an independent source out there to balance, Amazon Music, Apple Music, Google Play, and the big giants. I think we need choice in there as consumers, even though a lot of these small ones are all going to fall away. That's it for Spotify. Now we need Pillow X. Last week we introduced the new pillow, Pillow X. Please subscribe to Valuetainment, the #1 channel on the internet for entrepreneurial content. And until next time, I'm Tom Ellsworth, and I hope I left you better than I found you.